We're reporting strong results this morning. That's been driven by strengthening right across our markets in London and also in retail, but also by our actions, and we've driven a substantial part of the increase in valuation through those actions. Profits and earnings are up, and NAV is up substantially, driven by an increase in our valuation. And the dividend has been increased. Our total accounting return for the year is 20%, and once again we've outperformed the UK market. What's really striking is how much effect our actions have had. We've really driven a substantial amount of the increase in value of the business over the course of the last year. Of course, yield shift has been a factor too. We've been repositioning the business around several key themes this year. We've been net investors in the market, taking on more risk, mainly in the form of development and increasing our exposure to London and the South East. We've executed well against that plan, completing the 2010 development programme, replenishing our development pipeline, investing in attractive assets, and all the while improving our operating metrics. Well, raising equity 14 months ago allowed us to make some really exciting investments at attractive prices, and all of those were in London and the South East. On top of that, and slightly more recently, we've been taking advantage of improving investment markets to sell some of our mature retail assets. Operationally, we've had another strong year. Lettings were once again ahead of ERV, occupancy is up, and in retail, we're now pretty much full.
We've had a really good year in the office business, both at an absolute and relative return level. Over the year, we've made some really smart investments in the West End, and really that's about Paddington Central, and today that is looking a good deal. Secondly, we've managed to keep the pace and activity on managing the portfolio high. And then finally, really pleased with the development programme, but also we've been making some good steps in replenishing the pipeline for the future. We've had a really good valuation uplift in the office portfolio. Now that's sent against an investment market that is strong, so clearly we've improved our valuation through yield shift, but what I'm really pleased about is that we've also done things to help ourselves. So we've been active in terms of lettings, we've been active in terms of asset management, and then we've also been making great progress on the development programme. Well, the occupational market in London at the moment is very healthy, and that's something that we've been predicting for some time. And what is also good is that we're getting a range of occupiers. We're seeing some occupiers coming to the estate from the TMT, the insurance and the fund management sector. And what it means is that on a like-for-like basis, we're keeping the portfolio pretty full. At Broadgate, delighted to have a new partner, GIC, who we know well because they've been a major shareholder of the group for some time. We have a long-term vision of Broadgate, and GIC share that vision, so we're looking forward to working with them. We are doing 5 Broadgate, and there we're looking forward to giving UBS the keys to the building next year. We've also got Broadgate Circle, where we're providing retail and catering facilities. And then just around the corner, we're working up plans for 100 Liverpool Street, which will be in effect at the entrance to the estate by the Crossrail station. So Regent's Place, good contributor in terms of performance for the portfolio. We managed to attract Debenhams, people like Facebook and Manchester City Football Club. So the estate now is nearly full. And we've also managed to get a new rental high of just over £70 a square foot. It's early days, but already at Paddington Central, the valuation has significantly increased. And we've managed to attract more occupiers. We're nearing the end of a very successful 2010 development programme, and it's been a major contributor to the group's performance. The development programme is well over 70% let. Well, one of the things I'm really pleased about this year is how we've looked to replenish the development pipeline. And obviously a big part of that has been the scheme that we've been promoting at Clarges Mayfair, which is primarily residential but also provides some absolutely first-class office accommodation. We're also looking to draw up proposals for our Shoreditch scheme. And we would hope later on in the year to also make a commitment to start to develop the office at 4 Kingdom Street.
We've had a very busy, successful year, outperforming again. We've leased 1.7 million square foot of space. There's 450 deals. We've launched successful developments at Whiteley and Hereford. And we've bought and sold a lot of property. So all in all, yes, a very good year. Well, the leasing market's improved over the course of the year, as we were expecting at the beginning of the year. It's been with a great range of retailers, with our traditional retailers such as Next and Debenhams, creating a great new flagship store for Next at Camberley, but also expanding retailer formats such as Joules, Fatface and Topshop, all of whom took space for the first time out of town at Whiteley. Over the course of the year, we've seen retailers become more confident about the role of physical space in an omni-channel world, and that's what's given them confidence to accelerate store expansion programs as they see how the consumer shops in many different ways on different days. Despite the rise in internet shopping, our footfall metrics are consistently better than the market. Research shows nearly as many parcels are now collected from stores as are delivered to people's homes. And our exit surveys show up to 25% of people who go to our mid-sized shopping parks are using click and collect. So it's not surprising that footfall trends on our shopping parks are consistently ahead and a key driver of our overall outperformance in footfall. For a number of years now, we've talked about polarisation in the retail market and how we believe that the best space is going to outperform secondary space, and there's going to be a continued divergence. And we've seen that over the course of this year. Our consistent rental growth performance gives us comfort that we're providing the right kind of space. Our rents have been growing as the economy has grown, but that's not the case with the secondary market. Stock selection is so important. We've invested in our assets to ensure they remain relevant to consumers and occupiers, and traded some of our more mature assets. Over the past 3 years, we've been looking at continually repositioning the portfolio. We've sold assets where we think it'll be too expensive to reposition them to a modern format, such as Basildon and Bon Accord. And we've bought high quality assets where we believe they will deliver the space that retailers and consumers want. This is why we've recently increased our holding in Hercules Unit Trust from 40% to 60%, and the 26% equity share in a portfolio of some of the best Sainsbury's superstores in the country. It's been another busy year on the development front. We started the year with the opening of Whiteley, which had an incredibly successful launch, and we're now on site with Phase 2, which should open in 2015, which will be a cinema-anchored scheme with food and beverage. During the year, we've also completed a major extension to Glasgow Fort Shopping Park, where we've added a cinema and food and beverage offer.
It's been a very active year for us at British Land this year, a year of delivering on our strategic objectives. NAV is up by more than 15% to 688 pence, and profits have increased by over 8%. As expected, earnings per share are down, reflecting the sale last year of Ropemaker. Combined, this is a total accounting return of over 20%. The main drivers for the increase in income during the year have been investing our placing proceeds, the completion of a number of our West End developments which have contributed materially to income, and a healthy increase in like-for-like income growth across the standing portfolio, net of the impact of prior year disposals. Looking forward, rental income will benefit from contracted increases we've already achieved on our 2010 development programme, and it will increase further as we let up the remaining empty space, and we're positive about the outlook for that. In the current year, the dividend was increased by 2.3%, and we've increased the dividend again, this time by 2.5% for the forthcoming financial year, reflecting the confidence we feel in the outlook for the business. An important feature for our lenders is the strength of our debt metrics. Our LTV stands at 40% today, at the bottom of our 40 to 50% range. Looking forward, the level of LTV will be impacted by retail sales, capital expenditure and acquisitions, as well as valuation increases. So I can see that with ongoing strength in markets, and depending on the time of transactions, our LTV will be around the 40% level, perhaps a little bit above or a little below. We have a strong track record in raising low-cost debt from a range of sources. We've raised £1.5 billion of debt facilities over the last year. And I'm most pleased by our most recent facility. We took advantage of the market to raise £785 million unsecured revolving credit facilities from 14 lenders. Over the last 3 years, we've raised £4 billion of finance, and it means that for British Land today, we have no refinancing requirement for at least the next 4 years.
We put our business in good shape, as our strong results show. We've worked hard to build more growth into our business, reshaping our portfolio to deliver long-term performance. The scale of our investment activity over the last 4 years is substantial. We've been repositioning the business around several key themes this year. The first of those trends has been all about environments. What's very clear to us is that people are focused not just on the buildings which they occupy, but also the broader environments that they exist within. And that's something with our larger campuses, which are larger estates, that we're really seeking to take advantage of. London's really been an exceptional story over the last few years, and we've really been able to take advantage of it. Today, over 60% of our real estate is situated in London and the South East, and that's increased substantially. Crossrail is a very important part of the London story. It has the capacity to be a game changer. And we're now in a position where over 3 billion of real estate is situated within a stone's throw of a future Crossrail station. We've been very focused on the importance of physical retail within the modern retail world, even indeed in an omni-channel world, if you like. The characteristics, having said that, which will make retail real estate successful going forward, are not always the same that have been true in the past. Finally, development has been critical for us, as you know, over the course of the last few years, but we believe it will continue to be very important. That's why we've been so active, not just completing our 2010 programme, not just letting it up, but also rebuilding that programme, and we've been very successful in that rebuilding process. Across the UK as a whole, we're still in the early stages of an economic recovery. London residential is a little bit ahead of London offices, which in turn are ahead of retail outside London. And that's actually not that surprising. When you think about it, the London economy has recovered more quickly than the broader UK economy. So looking forward, in London, where we've seen a lot of yield shift come through, we believe that performance will be broadly generated from rental growth. And that's something we do expect in the coming year. More generally, in retail outside of London, as I say, that we're at a slightly earlier stage in this cycle, and we do now see quite a lot of investment demand coming in, reflecting a stronger economic performance. We've delivered strong results, and the business is in good shape. Around half of our performance over the course of the last year has been a result of our own actions and our own decisions. It's those actions and those decisions which leave us in good shape looking forward.